Good afternoon, everyone, and welcome to TBR's webinar, How is Cloud Disrupting Vendors' Hiring Strategies, which will walk you through the high-level results reported in our Global Delivery Market Report. My name is Allison Crawford, and I will be your host for today's session. The global delivery market continues to evolve, and vendors are investing in platforms, infrastructure, and personnel to deliver IT services from nearshore and offshore locations. As client demand shifts, so do the winning strategies to support them. The results of TBR's most recent global delivery benchmark will provide insight to executives who are allocating resources and identifying what locations, solutions, and platforms provide the greatest return on investment. Over the course of this presentation, we'll review what trends have popped up, which trends have remained, and what this means for your offshore, nearshore, and onshore strategies and investments, followed by Q&A. So I encourage you to ask questions throughout the presentation. But before I pass this over to Ramunas, there are a few logistics I'd like to cover. First, we're recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others that we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function. The analysts will address them at the end of the presentation. Or if you'd like to set up a client inquiry for a private discussion, please reach out to any one of us at the end of the webinar to set up that conversation. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find these slides as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight. And I'll share all the social media links with you again at the end of the presentation. Now let me introduce you to all of the analysts presenting today. Your speakers are Patrick Heffernan, Ramunas Svarcas, Hristov, and Jacob Gordon. Patrick is a State Department and Deloitte alumni and leads our professional services research team. Ramunas Svarcas is a principal analyst in the professional services practice where he has covered the IT services market for the past 12 years. Hristov is an analyst covering the global delivery market, cloud services market, as well as management consulting. Jacob is a research analyst researching the public sector, cybersecurity, and cloud services market. Together, these analysts bring a wealth of knowledge and experience obtained through past and ongoing interactions with existing IT services vendors to our clients. Their work on this report has been hailed as mission critical and strategic to customers subscribing to it, and we look forward to sharing with you some of our insights today. And with that, let me hand this over to Ramunas.
Thank you, Allison. Before we get started with the content of this presentation, just a quick overview of what the Global Delivery Benchmark is. For some of you who have purchased this offering, you're probably well aware of what is contained in it. For others that may be the first time that's seeing this information, just kind of a quick overview. The Global Delivery Benchmark really compares and contrasts 14 different vendors with differing business models to really better understand how headcount is expanding within the IT services arena. The reason we only have 14 vendors is that we really picked a representative sample of companies with different business models to really understand and figure out how things move in the marketplace. Clients use this benchmark report to compare and contrast their own services headcount delivery models. And, they're really trying to figure out how these models are evolving and if the clients themselves and their companies are moving, with the market, are they ahead of the market or really behind the market. Today, we're going to really be examining some of the top-of-the-mind findings from the benchmark. Specifically, we're going to be looking at, how headcount growth is evolving over time and where does it stand right now in terms of a growth rate. We're also going to examine where profitability stands for these vendors. Is, in fact, there any improvement in profitability as personnel are rearranged and changed and or the overall headcount composition changes. And then at the tail end, we're going to do a little bit something different than we've done in the past global delivery benchmarks. We're going to really review the nearshore Americas opportunity, sort of a special focus on that area and basically our region of the world where we work in. One of the things that, just within the last day, I had an interesting conversation with one of the vendors, and we know that headcount is a key element of delivering services. And virtually all of the vendors that we've talked to and we look at and are included in our benchmark are telling us that there is a transformation in personnel in terms of how we're delivering, and there is changes in the way that the global delivery models are evolving. So with that, I'm going to turn over the presentation to our lead analyst, Boz.
Thank you, Ramunas, and hello, everyone. As Ramunas pointed out, we want to touch base on the 3 key takeaways and trends that we have identified throughout the global delivery benchmark study. The first one we want to discuss is what happened to the headcount over the last 6 months. As you can see on the slide, it did continue to decelerate. The growth continued to decelerate, and as we can see on the next slide in the presentation, there's a correlation and really a snapshot of what has been happening with the headcount growth for the 14 vendors in the study. The graph reflects the weighted average between headcount growth and revenue growth. The green bar represents the revenue, and the gray one represents the headcount. And as you can see, the headcount growth has been decelerating for 11 consecutive quarters, all the way back from 3Q11 up until now 2Q14, and that's a trend that continues. The revenue, the headcount growth was surpassing revenue growth throughout from 3Q11 to 2Q14. The reason being the vendors were playing catch-up. They were trying to build their global delivery models. They are trying to augment their services to position themselves for more competitive advantages, particularly around price points, and establish low-cost presence in countries such as India and nearshore hubs such as Poland or Mexico that allow them to provide those competitive services. However, as we witness a shift from IT services to IT as a service and the widespread adoption of cloud and automation, we see how those disruptive technologies are impacting hiring strategies. And that was reflected in the most recent time view in 2Q14, seeing the revenue growth surpass headcount growth, which we identify as a trend that we believe will continue, and that's mainly driven by automation, allowing vendors to drive nonlinear growth. Firms are continuing to expand their IP portfolios of cloud and analytics solutions to deliver higher value outsourcing services and rely less on labor so they can boost profitability. Vendors are pursuing selective hiring. They're hiring more cybersecurity specialists, data scientists, sociologists, lateral to industry expertise that will allow them to deliver those higher value services and allow them to remain competitive in a market landscape where cloud and automations are prevailing and driving business today. On the next slide, we can see we have the vendors in the study, how we group them. The first group we have is the traditional system integrators with hardware and maintenance. Second group is pure SIs and the India-centric vendors. And as the chart pointed out, the SIs with hardware and maintenance and support are the ones that are really focusing and adopting automation in the service delivery the fastest. And as you can see, their low-cost headcount contracted 14.7, onshore headcount was down 8.5%, and that's because they're rebalancing their workforce, they are divesting units with support, and they're more focusing on staffing, more staffing their bench with high-value service personnel that allow them to deliver, to support disruptive technology and with a high focus on automation. The SIs title low-cost delivery with industrialization and automation to reduce costs, while they're creating differentiation by offering vertical-specific solutions that, again, they are adopting automation, but we don't believe as fast as the SIs with hardware and maintenance. And the third group, the India-centric vendors, they are the ones that are disrupting the market faster than the other groups in the sense of we've seen they're climbing up the value chain. They still have the low-cost delivery leverage and the human element, and they have the largest base in low-cost hubs such as India. However, they have started expanding onshore to increase client face time. As pointed out on the numbers, the onshore headcount growth surpassed the low-cost headcount. That's really a reflection of their strategy to climb up the value chain, provide more high-value services so they can capture those opportunities as clients seek more of high-value service solutions deliver in the cloud environment. The next slide is going a little bit deeper dive around the vendors and really showing us a more of a how automation and how vendors are rebalancing their workforce structures, which vendors are investing in IP, and it's kind of a mixed bag of results in terms of headcount growth versus leveraging IP. And some of the vendors such as Accenture and Capgemini and Cognizant HCL accelerated their headcount additions, somehow contradicting the overall trend. However, those companies continue to seek support growth strategy and diversify their global delivery revenues and increase the leverage of low-cost resources for service delivery. The traditional outside vendors with hardware support and maintenance, such as HP, Dell, IBM, CSC, T-Systems, Atos, they reduced headcount. As a result of ongoing reorganization efforts, and they're all shifting from an outsourcing-centric model to manage value-added services, particularly around cloud. A couple examples I want to share with you here. For example, HP announced for the layoffs, as you probably most of you are aware of, plan to reduce around 7,000 people in 2H14 and 4,000 to 9,000 by the end of fiscal year 15, with a total of 45,000 to 50,000. And most of the headcount is around services, and that's offsetting and divesting units with a low-cost support and more adding staff that's more of a high-value service that can deliver more high-value services. Dell increased its IP-based security offerings to improve the value proposition its portfolio across the highly sensitive areas such as cloud, mobility, and healthcare. Dell's acquisition of SecureWorks really helped the company to stand alone as a group and will deliver security-related services to customers. The company also launched advanced endpoint threat detection solution, secure mobile access solutions, vulnerability and prioritizing services solutions that will help to enhance portfolio offerings to help the company as it's rebalancing and reorganizing its workforce to deliver those high-value services and solutions.
So with that, I mean, one of the things that we see is there's a lot of difference between the various vendors in terms of what's happening with their headcount and their strategies specifically. And while the overall market definitely shows a trend, these differences not only manifest within the vendors themselves, but they also have impacts in terms of geographic location of where they're moving their headcounts.
The trends we observed in the first half 14 global delivery benchmark are a continuation of those observed in the previous 2 years. Vendors are slowing the pace of hiring in both low-cost and onshore markets due to increasing use of automation and the transition to as-a-service business model. Onshore headcount in the Americas and EMEA were hit particularly hard due to restructuring efforts. Low-cost offshore or nearshore headcount increased in the quarter due to India-centric companies scaling their operations and MNCs such as CSC and Xerox adding low-cost resources to catch up to their peers' global delivery capabilities. America's headcount declined 0.5% in 2Q14 due to broad-based headcount restructuring efforts in the U.S. Low-cost America's headcount continued to decline in the quarter due to vendors eyeing Latin America as an increasingly attractive location, as it can both serve the growing local IT services markets in the region while having the proximity to support North American markets. Vendors are particularly interested in expanding in Brazil, as it remains the most consistent low-cost America's growth region due to accelerating demand for IT services in the country, attributed to its push to become a global economic player, as well as it having the largest economy and population in Latin America, allowing companies to scale easier in the country and have access to the multi-billion-dollar IT services market. Vendors such as Infosys are expanding in Brazil, as evidenced by its new 100-seat SAP Development Center in Araguaia that will initially support application management services to Citroscu, the world's leading orange juice producer. Along with Brazil, there are other emerging delivery centers such as Guatemala and Costa Rica that are becoming more attractive to vendors due to their low-cost characteristics and relative abundance of bilingual speaking skills. APAC headcount growth decelerated slightly, but remains strong relative to EMEA and the Americas. Vendors are scaling their presence in APAC to serve the growing IT services needs in the region. China headcount growth was a standout in the region, growing 10.4% in CQ14, as companies seek to capture a slice of the growing IT services market, where companies are beginning to embrace outsourcing on par with their Western peers. China remains in an engagement-driven market where vendors are adding headcount on an as-needed basis. India headcount growth slowed in CQ14 due to vendors adopting automation and rising wages in the country are eroding its low-cost appeal. Vendors are scaling in other low-cost APAC markets such as the Philippines, which offers a plentiful supply of skilled bilingual speakers. Xerox recently moved its finance and accounting operations to the market to reduce costs, and Accenture also recently opened a new 150-seat BPO center in the Philippines as well. EMEA headcount continued to decline due to slow demand for IT services in the region and headcount optimization efforts from companies such as Atos and Capgemini, which are reducing onshore headcount to become more price competitive. Companies are expanding in nearshore locations such as Poland, which is close to Western European markets and has a significant amount of university-trained talent on offer for considerably less than its Western European peers. Vendors are scaling their presence in Africa and the Middle East to capture emerging opportunities created by booming economies and companies that are modernizing in hopes to become regional and global players. Accenture, a couple of examples of this are Accenture is adding headcount in South Africa, and TCS recently opened a BPO center in Saudi Arabia. Although these markets are nascent, they hold a lot of promise, and a lot of vendors will start to add more headcount in the region going forward.
So as we can see, the market definitely is evolving in different ways, in different shades and forms, and many of those vendors are moving in different directions. The real question that comes to mind is, are they making money, and is this actually contributing to their profitability? With that, I think Boz is going to take over and take a little discussion on what's happening in the profitability world.
Sure, yeah, absolutely. I mean, as we mentioned earlier, headcount has been accelerating. We saw revenue accelerating and kind of driving a nonlinear growth model and really impacting the profits of vendors and how they are improving the profitability is the key question, and how they're able to make money at the end of the day. And that's really the second part of the presentation is the profitability improvement. It really depends on the vendor's ability to attain laterals, which are becoming expensive, and if they cannot, and they're scarce, if they cannot, they are pursuing freshers hiring and then train them at or ahead of the pace of the IT services market evolution. Really, the scarcity of the cloud and analytics ready talent and the increased cost associated with attaining laterals, which the skills have forced vendors to pursue accelerated recruitment of freshers. They can groom them and deploy them as needed. And now we've seen that trend more so with the India-centric vendors than the traditional SIs and SIs with hardware and maintenance. However, these vendors are able to maintain a lean cost structure and improve profits. Additionally, cultivating broader skills improve vendors' ability to understand and address clients' needs, to deliver business outcomes in a creative and really holistic ways, particularly around data analytics, where wide range knowledge of language and consumer behavior improves the precision of algorithms and really enables vendors to drive higher value services. The next slide, we're going to go a little deeper into that because as we can see, that graph represents the low cost leverage versus operating margin. As we all know, low cost lever, and that has been the key leverage allowing vendors to improve profits over the last decade. And as we saw, that lever still exists, however, it's shifting. And it's really the vendor's ability to balance low-cost leverage and investments in automation and IP-backed assets that allows them to pursue higher margin offerings and capture such engagement. For example, SI vendors continue to balance that with high-value services and integrate industrialized delivery and analytics for operational excellence that allow them to more of a standardized operation and really allow them to improve and increase the quality of services that they provide. Vendors such as Dell, T-Systems, and Xerox so deep in the operating margin They were burdened with cost of workforce rebalancing and restructure, so they saw profitability to decline in over year to year into Q14. Other vendors such as IBM, while they continue to rebalance their workforce, the favorable compare that was offset increasing operating expenses stemming from a large cloud investment, and so improve in the operating margin into Q14. Capgemini launched an augmented competitiveness program, which offers savings for clients through low-cost, industrialized, secure, and flexible services that allow them to improve quality of service. These systems saw a dip, and then they saw really the margin almost went flat into Q14. What the company is trying to do is really to rebalance and kind of to divest the low-cost support units, but they're also improving profits through T-Systems 2015 Plus initiative, kind of long-term investments for the company, which focuses on a high growth opportunities, so of course around cloud instead of traditional IT systems. Xerox reduced services headcount to realign its business concentration towards the BPO and document outsourcing service lines, and incorporate more automation into its services, delivered to improve margins. And the India-centric stack, it's always been the one that's intriguing a lot, and as I mentioned earlier, India-centric vendors are climbing up the value chain. They are capturing share of the market, and also sustaining leading margin performance. Some of them saw a margin decline, Cognizant and TCS, and that's due to those vendors. They are hungry for innovation. They are looking to climb up faster than their peers. So they had to rebalance, and they offset a wage increases in hiring ladders, and that's what they saw. For example, that was Cognizant's case, where wage increases in hiring ladders, especially onshore, experienced a decline in their margin. TCS is certainly trying to depart sooner rather than later than everybody else in the Indian-centric stack, and invest in R&D, which forced the company to experience a margin decline to Q14. We expect those companies, Indian-centric companies specifically, to continue to leverage their low-cost presence. However, some more than others will be adopting automation and IP-based assets faster than others, and that will allow them to depart from their traditionally low-cost outsourcing status and become more of a outcome-based solution vendors and perceived by clients in that way, which will help them to drive more profitable business. On the next slide, it's really another level of a layer of seeing how those vendors are doing in terms of change in operating income per employee. And if they're not hiring, are able to make money, each of those employees will be able to make money. And that's kind of like the key focus of the chart. The three companies that are standing up in the chart, HP, CSC, HCL. Essentially, at CSC and HCL, we've seen operating income per employee change growth to be the leading over the last 6 months, and prior to that, HP joined those two in operating income per employee. Headcount reductions, increased use of low-cost labor, and improved contract management positively impacted CSC performance. Automation improved employee utilization in more efficient operating structure, boosted HP's operating income per employee growth during Q14. HCL is the perfect example of the India-centric stack, where the company continued to leverage and promote its income per employee growth, continued to promote its IP-backed assets such as AOT, ACM platform, and expand its value through management of developed solutions for clients, which really results to boosting the profits. The company continues to integrate data analysis and cloud capabilities into product management solutions, such as intelligence assess engineering, to improve efficiency and revenue opportunities for clients. Although companies are able to manage and see a growth in operating income per employee faster than the rest, we see, for the most part, with the exception of a few of the vendors, companies are able to generate money from their employees, and they're making a profitable business from per employee basis. And that's due to hiring laterals. However, hiring high-value laterals is pushing attrition, because there's an environment that creates opportunities for for staff to job hop and seek other opportunities, better paid opportunities. And I'll turn over to Jacob, who will go over the attrition and how it is impacting, and we believe will impact profitability.
Average low-cost onshore and overall attrition continued to climb in PQ14 due to headcount restructuring initiatives aimed at reducing redundancies and increased demand for lateral hires with analytics, cloud, and mobility skills, leading vendors to increase salaries for people with those skills, which resulted in higher turnover as employees left to pursue better compensation elsewhere. Increased turnover is damaging morale and impacting client relationships because it impacts continuity of the relationship. Vendors are addressing attrition with increased salaries and investments in their training and development programs. These investments will impact vendors' profits in the near term. Some companies such as Xerox are addressing turnover issues by leaning on software to improve the hiring process. Xerox is using big data tools from Evolve to improve its call center hiring process by identifying ideal candidates who will stay on the job longer than 6 months so Xerox can recoup its training investment. The Evolve solution lowered attrition by 20% in the call centers that were using it. We predict that more companies will start to use software, especially analyst software, to help them identify better employees, and this will continue into next year.
So we just heard that, we're seeing quite a bit of difference again between the vendors. Certainly attrition is an issue, but it is a consequence of all the changes that are happening in the way people are being hired. Skill sets have to improve. People are looking at higher value skill sets. And at the same time, when looking at it from a geographic standpoint, we see that there's still hiring of low-cost resources in various regions of the world. Specifically, we're going to focus on the Americas market.
Great, thanks, Ramunas. So we wanted to use this opportunity in doing the Global Delivery Benchmark to dive a little bit deeper into nearshore, looking specifically at a few countries and a few, we can go back one.
Yep.
There we go, beautiful.
Thank you.
The one that I had.
Perfect, yeah.
Okay.
So we looked at a few countries specifically and a few specific vendors to try and crawl under the hood and get a better sense of what's happening more specifically in these countries. And our focus initially was how U.S. clients are served by nearshore outsourcing operations, but we ended up learning a lot more about the different service line splits and then what the difference is between U.S. clients being served and then global or regional clients. So looking at this particular chart, two big things stand out to us. First, if you focus just on Canada, you can see that with the exception of Xerox, it's CNSI that really drives revenue there. So, and it's kind of obvious. Access to skilled workers at relatively lower cost, easy availability of technical skills and business graduates, and then, of course, a lower corporate tax rate in Canada in comparison to the U.S. And then when you look at vendors like TCS and Infosys that generate about 70% of their Canada revenues in CNSI engagements, what we found is that about between 85 and 90% of those CNSI engagements, of those revenues, are for U.S.-based clients. So they're helping them to capture the more lucrative revenues while leveraging that low cost in Canada. Now, we think that these kinds of splits that you see in Canada are going to persist as long as the larger macro factors, both the U.S. and the Canadian economy, the education system, the availability of good skilled graduates, as long as all that remains, and the tax environment, all that remains true, I think we'll see these trends continue. So now, rather than look at one country, now look at just BPO, just the BPO segment across all the different countries, and you can see that BPO is really delivered mostly from the low-cost countries, and again, that makes sense. Time zone proximity, language, cultural affinity, access to a growing pool of educated workers with skills in finance and accounting, it makes them smart. and we do think that BPO will remain a key service line, although we think that the vendors are going to look to diversify their portfolio offerings away from just BPO as U.S. clients increasingly look for low-cost, secure IT infrastructure management services. So initially, we think vendors will establish IT outsourcing and IT management as a service offerings as a result of their current client engagements. And Jacob mentioned earlier that, you know, China is an engagement-driven market. I think the same as it could be said for the countries that we've listed here: Guatemala, Costa Rica, and Mexico. So as the engagements that they already have solidify, we think they're going to look for increased revenues through other services. So I had the pleasure last week of being in Guatemala and heard repeatedly that it's not that the expected return from the initial engagements or even the first pool of BPO clients, that's not what's driving the long-term sort of broadening and deepening of nearshore IT services. They think that they don't, and again, this is mostly in Guatemala, although I spoke with people from Mexico and Costa Rica as well. They expect that they will become fully diversified IT services vendors, supporting U.S. clients and perhaps more importantly, supporting global clients that have operations in the U.S. or have operations regionally. So, and if we stick with Guatemala for a moment, we saw that some of the vendors really haven't gone into Guatemala and Costa Rica, and others like Capgemini are taking full advantage of the local resource pool and initially offered services like F&A to support CRM and supply chain. Again, this is our effort to dive deeper into these particular countries in this particular market. And so there was collaboration with the local governments, similar to what Infosys did with the Costa Rican Investment Promotion Agency, it's a long name, to train students on SAP and cloud technologies. We think that's going to help the local talent, help the local companies move up the IT services value chain. We also heard about the Guatemalan government investing in a year-long, essentially a finishing school for STEM graduates to help them improve their English language skills. So they finish a 4-year degree in engineering or IT engineering, and then they're able to go on and spend 9 months to a year just working on their English language skills. This is the kind of public-private partnership. It's initially being funded by the Guatemalan government and the Inter-American Development Bank. But this kind of thing is going to pay off massively. Every single person I met from Guatemala, Costa Rica, Mexico, Nicaragua, Honduras, Argentina, they all lamented the lack of English skills and, as a result, a constant war for talent, tying back to what Ramunas was saying about attrition. So that takes us to the next slide. Pardon me, brought back as part of my global delivery. I globally delivered a vicious cold back to New Hampshire from Guatemala. Not Ebola, I promise. Yeah, so talking about the hiring practices and how the macroeconomic and IT services market sort of dictates hiring practices in these different countries. So if you look at looking at this chart, if you can, look at just the Canada line in each vendor, and you'll see that the headcount splits are almost all weighted towards experienced professionals. And that makes sense. It ties back to what I just said about CNSI. They provide that consulting expertise. They're deployed in a timely manner. They support the CNSI revenues. And again, we saw this on the last slide, and that just reinforces what that mix is. So in contrast, you look at the young recruits. I know they're up here as freshers. I hate that term, so I have to say young recruits. With the good communication skills, with domain-specific knowledge, speak multiple languages, that's the resources that vendors prefer when they're staffing up in their delivery centers in Guatemala and Costa Rica. I want to look at Cognizant, though, for a moment. Cognizant is different from its peers in terms of its hiring practices in Mexico and Guatemala. They prefer to hire experienced professionals, laterals in these two countries with skills in cloud, in virtualization, in basic people management, SRM, supply chain, the rest. It makes a lot of sense. The teams in these countries are still small. They're primarily providing CNSI support out of Mexico and ITO out of Guatemala. U.S.-based clients from those two countries are roughly 70% and 90% of the total clients served. And the talent distribution within Mexico and Guatemala indicates these two markets in particular are increasingly gaining the advantage over the other Latin American countries. They offer the lowest cost, highly skilled, nearshore talent that can support clients as they begin to adopt a cloud. Now, I fully recognize I'm completely biased because I just spent a week in Guatemala and spent a lot of time speaking with some folks in Mexico. So there are a lot of people that are very bullish on their own economy and their own prospects. I will say it's a very infectious enthusiasm, not just the cold I have that's infectious. There's a lot of hurdles. They don't have enough talent. They do not have, particularly in Guatemala, perfect IT infrastructure. There's also not enough local demand to sustain any downturn that comes from when demand from abroad slows down. All those three elements, though, the talent, the infrastructure, the local demand, those are elements that are all being addressed on the ground aggressively. So I think in 6 months to a year when we revisit these numbers, I'd be surprised if we see anything other than sustained or substantial growth across these two countries in particular.
So, I mean, we're basically just seeing that, you know, we recognize that overall headcount growth is contracting to a certain extent, but that's not necessarily true on a regional basis, and it's not necessarily true for all the companies. Profitability is definitely there. We're seeing the impacts of profitability in terms of how headcount is being rearranged, and it is having a positive impact. We know that the IT services business is a people business. In spite of all the automation that occurs, even those people, you know, and those jobs that are being automated, somebody has to manage the automation. So you're replacing one skill set of people with another skill set of people, so that's still occurring in the marketplace. And those skills right now are the ones that are in demand and are creating some headaches. As a consequence, we're seeing that attrition is increasing because people are trying to steal each other's experts. And then finally, I mean, we definitely see that, you know, the evolution in the Americas is not unlike or dissimilar to really what's happened in the Indian market over time. And actually, it's, you know, it's mimicking the Indian market to a certain extent as well. Starting with the low-cost positions, the easy outsourced positions, focusing on delivering, you know, locally, except in the Indian case, they were delivering locally to the Americas because they picked the biggest market to deliver to. But they're all targeting the U.S. as a prime area for delivery for the future. But they recognize that they have to build models that also sustain their respective countries that they're supporting. That generates the sort of the core base for operations and then extends into the U.S. market. So with that, we're going to open up the floor for questions.
Great. So thanks to those of you who've sent questions through. If you have any additional questions, please send them through at this point. The first question we have is, hold on, I'm getting back there. Have you seen any indication that the Japanese market is becoming more open to non-native providers?
Thank you. So have there been indications? Yes, we have an example which I can think of my head right now. TCS moved in aggressively, so to speak, in the Japanese market when it came down to merging with Mitsubishi's IT Frontier unit and establishing, essentially tripling its presence in Japan. I think that's kind of one way for those vendors that are not Japanese native, they're able to establish subsidiaries and or merging with the local vendors that have the presence, have the faith, the language that will allow them to penetrate the market. I know Accenture has instances and attempts to penetrate Japan. Currently, more of a small scale, more of a local and state and local government focus around BPO. And I know that some of the India-centric vendors, Infosys and Infosys, has tried to move into that market. Japanese culture, business culture, is traditionally insular. So while we see vendors attempting to penetrate, there's still a lot of pushback, we believe, from local vendors like Fujitsu and NC Data that are still the dominant in that market.
Okay, the next question we have, you discussed how cloud and automation are beginning to dictate vendors' hiring strategies. We saw the positive change, at least for most of the vendors, in operating income per employee. What has been the impact on revenue per employee, and is there a line of business where the metric is performing better than others?
So I'll take that question too. I mean, the trend in the change in revenue per employee has been similar to the operating income per employee. Essentially, the development of IP really helps us transition to automation and improvement in project management that has helped vendors to drive nonlinear growth across all the line of business. Essentially, I mean, of course, each business line has leaders and laggards in change in revenue per employee. The ITO service line, although from a much smaller base, India-centric vendors have continued to deliver more robust ITO revenue per employee growth compared to the SI peers. Essentially, India-centric vendors focus on less labor-intensive, remotely delivered, automated infrastructure management offerings have helped set the record positive revenue per employee growth in that particular line of business. In BPO, we see a trend where vertical-specific platform BPO solutions and efforts to eliminate redundant, commoditized operations are really the primary drivers for nonlinear growth across vendors in the study. IBM is a good example. They're investing its BPO customer BPO unit, and they're really getting over 30,000 people off its payroll, selling it to Phoenix, closing the deal in Q14. Vendors such as Infosys have invested in vertical-specific solutions like clinical trial supply, which have helped to reduce the need of labor-intensive tasks and drive the revenue, BPO revenue, and higher than headcount growth, which essentially translates to nonlinear growth. So net-net, it's really a similar trend, and depending on the service line, depending on the vendors, some are laggards, some are leaders.
Okay. We have another question just come through that seems kind of interesting. Some providers have U.S.-based delivery resources in low-cost cities. To what extent are domestic delivery resources differentiating certain providers?
It's a great question. It's a great question because it set off alarm bells for me, and I think it set off some deep analytical thought from my colleagues here. My sense on that question is it's exactly the kind of thing that we use this benchmark to do, and that is explore the aspects of global delivery that are changing, that are evolving. It's why we did the deep dive on nearshore Americas. I think that's a perfect example for something for us to dive into for the next benchmark. That said, I know Ramunas and Jacob both have thoughts on what's happening there already.
So certainly, we know that some of the vendors have done that and have basically are utilizing areas in the United States that, the cost of living is low, the salaries are lower, they can provide services, and they don't have to deal with those, many times, the language issues right off the top. I mean, it's an instant win from that standpoint. The fact of the matter is there's still other regions of the world that provide even lower cost delivery capabilities. So it really becomes a question of, does it need to be in the U.S.? Is the quality of service that much superior? And that's really the differentiating factor in that, from that standpoint. If it's very imperative that there are no language issues and the people that are providing the services are knowledgeable and, or can be taught and educated very quickly in terms of what services they're providing, it's a win-win because, there's always the push of, let's be U.S.-based, let's deliver from U.S., and let's provide a U.S. services. So it's a key differentiator from that standpoint. But, many times it's really a trade-off of the value versus the cost.
And there's some recent examples of vendors expanding in rural, low-cost onshore locations. CSC is one of those. They have a very clear strategy about to go about that. And I think, you're kind of seeing in CSC's case is that they added a new location in Louisiana, which is focused on cybersecurity, and a location in Pittsburgh, which is focused on cloud. And I think, they're choosing to do their cyber and cloud in the U.S. because those things are they have a lot of public sector contracts. They're U.S.-based, and these types of things like cyber and cloud, people really want to know that they're done onshore and that they're secure. And it's allowing them to kind of differentiate themselves, especially in the public sector space, where they can kind of have these low-cost cyber and cloud capabilities, which are, which is something very different from their competitors, their public sector peers like Lockheed Martin, IS&GS, which lack those low-cost capabilities.
Okay. We have a couple more questions in queue, so if anybody else has any questions, please send them through now. Next question we have is, based on your research, are vendors generating sales primarily from U.S.-based or global clients?
Yeah, that's a great question. Yeah, U.S.-based clients are still a predominant driver, but it depends entirely on which vendor you're talking about, and even which country you're talking about. So we have the data file, the Excel file up here, and look at Xerox. 70% of its Canada business, Xerox Canada, 70% of its business is coming from U.S.-based clients. Xerox Guatemala, 40% of its business is coming from U.S. clients. So, there's one vendor with operations in two different countries drawing dramatically different sets of revenue. This is not dramatically, boss? You voted. Okay, yeah. All right. I got a head shake from boss. I'm not sure if I said something wrong there. So, I think, and again, to reflect on what I heard in Guatemala at the outsourcing conference there last week, the U.S. clients are essential for gaining scale, but long-term, I think a lot of the providers, outsourcing providers in Guatemala, Costa Rica, Mexico, the rest, are looking for both a solid local base for providing IT services, and then more importantly, a regional clients or global clients with operations in the region that they can attract and then retain. I hope that answers the question.
Okay. So last question we have right now, everyone. While Patrick died in the corner, I'll just wait a second. You talked about trends in attrition. Have you seen any in utilization?
Yeah, so we have seen an overall trend in average utilization. It's improved across the board, and we attribute the increase due to companies' emerging use of tools to optimize their processes and improve productivity, which has allowed them to decouple revenue growth from headcount growth. We've also seen that the increased attrition has forced remaining personnel to bear the increased workload delegation across a greater breadth of engagement, which has positively impacted utilization. And an example I can share is that Atos's lean management program. It increased the leverage. It allowed it to essentially help it improve utilization through its workforce management tool, which led to a 70 basis point increase in Q14 at 74%. I think broadly in terms of utilization, you're really just seeing a lot of companies adopt new software tools that allow them to allocate the resources better and to improve their efficiency. I think you'll see that trend continuing into 2015.
I wanted to also add, there was a question that was raised around, we're basically correlating the impact of attrition in regards to profitability. And this is kind of on the same line, utilization also impacts profitability. What's interesting is that we're seeing attrition going up for everyone. One, we know that part of that dilemma is the fact that, talented people are being stolen. On the other hand, we believe very strongly that, the untalented people are not being actually offered, avenues for further advancement within their organizations, and or kind of getting stuck in little pockets. And that is kind of as a consequence, they don't get a salary increase, or it's very small, or so forth, generates attrition. And that is also a mechanism that we are aware is leveraged by many of the vendors to contract their labor pool, clean out the bottom rung of the ladder to a certain extent, and therefore also improve profitability from that standpoint. So it's a two-pronged kind of impact. In some cases, you lose people that you want, but at the same time, it also can help you clean out the people that you don't need.
And Atos is a good example of a company that's managing its people well. And we're seeing it across the board in IT services and professional services that who manages their people best is the companies that are doing the best revenue-wise and growth-wise and all the rest.
So we don't have any further questions in queue. So with that, I'm going to start to wrap up the presentation. So to those of you who asked questions and I've responded to you privately, we're going to follow up with you to get you some answers on the questions that you did send through, so look for those. For many of you who have asked about getting the deck, we will be sending the deck out to you tomorrow along with the link to the recording, so please keep an eye on your inboxes from that. And if you have a problem with getting the recording or the deck, please do feel free to reach out to me. As I mentioned, I'm going to share all the social media links with you, so I'd like to encourage everyone to follow the 4 analysts as well as TBR Corporate on Twitter at the handles listed here, as well as joining our social media conversations on SlideShare, YouTube, and LinkedIn. We are sharing a lot of the research presentations, and the analysts are putting up opinions on those avenues, so we do encourage you to join in the conversations there. As many of you who have been on these calls before are aware, we do collect some feedback from you at the end of every webinar. How valuable was the presentation? How good were the presenters? And if there's anything else that we're not covering that you'd like to see us covering going forward, we do really value this feedback. We use it to improve our presentations. We do realize that your time is valuable, so we want to make sure that you're getting the most out of the conversations. So we would really appreciate if you could just let us know how we're doing, and if there's things like, looking at the nearshore stuff was a perfect example in the open-ended feedback, that would be appreciated. I'm going to leave the chat function open for another couple of minutes in case there's any last-minute requests or questions, requests to have one-on-one conversations with the analysts. Wish Patrick his speedy recovery from his Central American bug that he's got. Anything, please do reach out to us now. And if we don't hear from you now, in the deck you can look at where all of the research that the professional services guys are working on. I think you guys are working on some predictions documents that are coming out, so keep an eye out on those. A lot of stuff coming out. Our new webinar schedule is going to be coming out in the next 4 weeks or so. So please keep an eye on those. We're doing a lot of stuff on IT services, cloud, and other things that are correlating to this market. So we'd like to invite you to join those conversations as well. So thanks, everyone, for your time, and have a great holiday at this point. We'll see you guys all in 2015.